Hey guys, JC Parets here, founder of allstarcharts.com, and I want to welcome you to our little powwow where we like to rip through some of the most important charts I am seeing. And you know, this is a great exercise because, you know, I talk to StockCharts and they're like, all right, JC, just, you know, share whatever you're seeing in the market. And that really forces me to think through, hey, what am I seeing in the market? What are the most important themes? And what's great is that I'm already doing this. I've already recognized this years ago, how valuable this is. You know, for premium members of All Star Charts, we do this at the beginning of every month where we look at monthly candlesticks. We'll take a look at some of these now. These were as of the end of last month. And then in the middle of the month, we do a mid-month call. It's actually next week where we go through this. And, you know, it's about 120, 150 charts. Sometimes I like to get a little crazy, and we've seen it in the 200s, but that's rare, where I'll rip through the most important charts. I think we could do it in about 150. So these are sort of some of the charts that I like to present at this. So it's great and then think about it for yourself. If you don't give these presentations like me, just for your own sake, you know, think about if you had to give a presentation on what you think the most important charts and themes are, what would that look like? I think it's a great exercise. Anyway, that's my 2 cents. Let's take a look at some actual charts and what I think is the most important stuff. All right. Excuse me, I'm choking because I'm so, you know, in disbelief that we have now seen 33 consecutive weeks where there are more stocks making new lows than new highs. And guess what? I don't know if you realize this, but in bull markets, you see the exact opposite. In bull markets, you have stocks making new highs, not new lows. 33 consecutive weeks of more stocks making new lows than making new highs. Great, the S&P 500, the Dow Jones Industrial Average, blah, blah, blah. All that's great, right? We're going to look at them. And in fact, the S&P 500 is here. But this is a market of stocks, folks, right? This is not a stock market. It is a market of stocks. So if the market is going to go up, just math, if the market is going to go up, you need more stocks going up, not going down. And we have just seen more and more deterioration. Now, the market peaked in February of 2021. That's when the new highs list peaked. That is when the advanced decline line in the NASDAQ peaked, Chinese internet, biotechnology, all the ARK funds, the IPO index, all of those things. You know, remember everybody had a SPAC, February 2021, right? That's when it's been deterioration ever since. Check my math majors. That was what, 17 months ago? 17 months ago. It's a long time, right? Long time. And if you want to be more conservative, you could say it peaked in May when industrials, financials peaked, and then you had the New York Stock Exchange advanced decline line and new highs list peaked in May. So you had like another, you know, sort of, either way, fine. So we're 14 months into this bear market, all right? But we've been in one for a long time. So we can talk about a zillion different ways to say that a new bull market has started, the bear market is over. There's a lot of different ways to be able to show that and express that. And, you know, you've heard it a million of them. I have said a million of them. All that's great. But if you really want to keep it simple, the bottom line is, if it's a bull market, you're going to have more stocks making new highs than new lows. You're going to have more stocks going up than going down. So if you're looking for the one thing that you can point to and say, aha, this is not a bear market anymore. We are in a bull market. More stocks going up than stocks going down. You know, be like, all right, JC, master of the obvious. Thanks. All right, fine. Maybe that's a little too simple for some people, but that's just the truth. So you can make things more complicated. And by the way, we do a lot more complicated things, but it really boils down to that. All right, so now that we have the market internals out of the way, we established that this is a market of stocks. I think the indexes are very useful. What do we have here? We have a prior uptrend in the S&P 500, sort of a distribution pattern, pretty classic. You can call this a rounding top. You can call it a head and shoulders pattern. You can call it, I'm sure there's other silly names for it. But the bottom line is this is a classic distribution. You know, the market peaked in February, even May. So as the indexes were still making new highs, into the end of the year last year, most stocks had already peaked and were already in decline, which is very standard behavior for the market, particularly in market tops. You see the same thing in market bottoms, by the way. You'll see the indexes making new lows, and you'll see the internals already improving. So for example, I don't have the chart here, but in 2008, 2009, the S&P 500 and the Dow bottomed in March of 2009. But the worst the market was in October, right? So with each new low into the end of 2008 and into early 2009, with each new low in the indexes, fewer and fewer stocks were making new lows. The internals had already improved. A lot of stocks had already started going up by the time the indexes bottomed out several months later, 5 months later. In this case, we saw the exact opposite. The market didn't peak till the end of the year last year, if you're looking at the indexes, but at the individual stock level, a lot of them had already been getting killed for most of the year, particularly since February. The worst ones peaked in February, right? Just like in the 2007 market top, right? The S&P 500 peaked in October of that year. But guess what? Home builders peaked a year earlier, and financials peaked earlier in 2007, and we're already rolling over on a relative basis for a long, long time. Lehman Brothers was already making new lows well before the S&P 500 peaked. There was already weakness. The market is very smart. That relative weakness was a sign then. The relative weakness in this cycle was those growth areas. That was where the relative weakness was. Those are the ones that got hit the worst, right? So now as we're making new lows in the market, what are we looking for? We're looking for the ones that are not making new lows. We're looking for the stocks that have held their May lows as the S&P and the NASDAQ making new lows. Which stocks are not making new lows, right? So, if you're asking me from the S&P 500 perspective, what I think it'll take, to be more constructive on a chart like this that looks very toppy, obviously, 4,100, 4,150, if we're back above those former lows, key Fibonacci extension level, we can say, we can move forward. We can be more aggressive. For now, anything from the long side, and we've been looking, I'm long ARC, I'm long Avalanche, AVAX. So we're in this mean reversion sort of trade. For anything more than that, I need to see more. For me, any longs right now for stocks or crypto is just a mean reversion. It's just a trade. Maybe it turns into something else down the road, but I'm not going into that with that mindset. I'm open-minded. Maybe in September, be like, oh, wow, we have more data. Things are looking good, et cetera, et cetera. But for right now, it's just a trade. It's just a trade. And there's nothing wrong with that, right? Understand your environment. Look at these tops in Ethereum and Bitcoin, right? Look at those tops. So unless we're back above those former lows, call it 30,000 in Bitcoin, call it 1,700, 1,800 in the Ether. There's really nothing to talk about there from the long side, right? Unless it's just a mean reversion, right? I'm fading 30,000 in Bitcoin, right? I'm fading that level. It's got to prove to me that it can hold above that. And I don't think it's going to be quite that simple. Maybe it is. Maybe it is. But that's not the bet that I'm going to make. The bet that I'm going to make is show me. Show me. So anything from here until then is just a mean reversion. It's just a trade. I'm long Avalanche, just a trade. I'm long ARC, just a trade. Maybe it turns into something more, but that's not the bet that we're making right now. Maybe we will in the future, but not right now. It's just a trade. So understand your time horizon. I was on TV the other day, Charles Payne, he's like, JC, what's one piece of advice you're giving investors right now? And I'm like, you wanted my advice? My advice is understand your time horizon. Who are you? Your time horizon is going to be different than mine and everybody else's. For example, even internally in my own company, while we might agree in the direction of the market or in a stock idea, which we generally agree to a certain extent, we debate back and forth which one's better than which, but we're generally on the same page. We're looking at price at the end of the day, so you can't really, argue with that. And even if we all agree, we'll all execute in different ways. Sean will sell premium or put on a bull call spread on a stock that we like. Straza will buy call options that expire in 2 weeks. I'll buy the actual stock, or maybe an ETF that stock is in and represents. The three of us agree on exactly what we want to do or the direction something might be going in, and we'll execute in three completely different ways. So just understand who you are, right? And it's going to be different than everybody else, and that's okay. There's nothing wrong with that. We're just at different points in our lives. Sean's a little bit more conservative than I am, or I should say a lot more conservative than I am. Straza's a lot more aggressive than I am and younger, right? Sean's got a couple of years on me, but, we're kind of in the same, boat. I'm a little bit on the more aggressive side than Sean, and that's okay. And we're all on the same team, too. So just to show you how much we can differ. And then, by the way, Bitcoin is not a hedge against inflation, in case common sense hasn't proved that already this year. Not a hedge against inflation after all. Never was. There was never any evidence that it was. There was some fairy tales, plenty of those. Never any evidence, though. And now we just have more evidence that suggests that it is not a hedge against inflation. At least not yet. Maybe one day it will be. Who knows? But we have no evidence whatsoever that it is. It is also not any sort of hedge against any bear market or anything like that. Obviously, Bitcoin and the NASDAQ move together. You could tell yourself that they don't. You could pretend that they don't. You can do anything you want. But they've never been more highly correlated, right? The positive correlation between Bitcoin and the NASDAQ has never been higher. 90, 30, 10, pick your time horizon. Correlation never been higher. I kind of wish that wasn't the case. I kind of wish Bitcoin wasn't correlated with the NASDAQ and we had an asset class that was like in its own world that had nothing to do with the stock market. I wish that was the case, but it's not. They move together. It's just what it is. So we have to trade the market that we're in, not the market that we wish we had. Yeah, I wish somebody delivered Alaskan king crabs for me this afternoon also, but that's probably not going to happen either. On that note, I'm probably going to order Alaskan king crabs. You can get them on Goldbelly. I don't know if you guys order Goldbelly.com. The place is awesome. I'm definitely getting king crabs, but they're not going to be there today. It'll be here sometime next week, but we're getting them. Shout out Goldbelly. All right. If there was ever a time that small caps were going to stop going down, this would be a pretty logical place for that to happen. This is the small cap Russell 2000, former highs. So 2018 highs, 2020 highs, pre-COVID, and we're back to the scene of the crime. Is it going to turn into support? This is the value line geometric index going back 25 years. This is the median stock. So in the Russell 2000, we have small caps, S&P 500, we have large caps. The value line is the median stock. This is your average Joe, or I should say maybe your median Joe, not your average Joe. But you get the idea, right? The way I see it, this is your typical stock in the market. And what do I see here? By the way, there's a ton of stocks in this thing. It's like 1,700, 1,750, something like that. So there's a lot of names in this. And we have a lot of data. It goes back a long time, which is why I like, it's the median stock. So it's a very unique index. And here we are, like small caps, if the value line geometric index was going to stop going down at any point, this would be a perfectly logical place for that to happen. Former resistance from the late 90s, 07 top, 2015, back to the scene of the crime. How about the New York Stock Exchange Composite? Here's your pre-COVID high. That former resistance, is it going to turn into support? If it ever was, this would be a logical place for that to happen. Look at the Dow Jones Industrial Average. Former highs, pre-COVID highs. Is former resistance going to turn into support? That is the question we're asking. Same thing with the Dow Jones Transportation Average. Is former resistance going to turn into support? Key Fibonacci extension levels. Same thing with the Dow Industrials. Key Fibonacci extension levels. Right? By the way, if you're interested in Fibonacci, you can go to allstarcharts.com/Fibonacci. You can see how we use these levels. You can see the highs in 2018, down to the lows in 2018, and we extend from there, right? This is it, guys. This is it. It's the US dollar index. This is it. You want to know what's going on? This is what you need to know. The US dollar index. This is the bully. We could talk about the bond market getting off to its worst start since like 1842 or something. Like, I swear the numbers are like ridiculous. Like, depending on how you calculate the bond market, like it's the worst start since 1842, like before the Civil War, right? Like crazy. Insane. So you can argue that the bond market crash and interest rates spiking are putting pressure, particularly on those growth areas, those long duration trades, as the bond market sells off, because those are essentially extensions of the bond market, right? So the bond market's a bully, but the real bully is the US dollar. Stocks and crypto are not going to go up this summer if the US dollar is strong. Bottom line. Bottom line. Look at the peak in the US dollar here. And by the way, people are like, oh, the late 90s, the correlation, but the stocks and the dollar both did well in the late 90s. Yeah, great. It is now 2022, not the late 90s. And we have to trade based on what the correlations are in 2022, not what the correlations were in the late 90s. Like, to me, that's common sense, but that's the pushback I get. But JC, in the 90s, it ain't the 90s. 2022. What happened at the end of 2016? Your boy Donald Trump gets elected. What happens to stocks immediately thereafter? One of the greatest years in the history of the stock market. That started when the dollar peaked. Dollar got smoked. Stocks ripped. Crypto ripped. Remember fall of 2017, your drunk uncle asking you about Bitcoin and Thanksgiving 2017, Christmas, holidays 2017. And then what happened? The dollar bottomed. Stocks and crypto peak at the end of 2017, early 2018. Dollar bottoms, starts to rip. Stocks and crypto under pressure. Crypto winter, Bitcoin winter, they call it, right? That's what the kids call it. And then what happened? In March of 2020, in the depths of the COVID crash, the dollar peaks. And what happened from March of 2020 on? It was the greatest 52-week period in the history of the United States stock market. Greatest ever. Dollar was getting slammed. And then a funny thing happened in the spring of 2021. The dollar bottomed. And what have stocks done since? They've sucked. So, if you think you're going to make money long stocks or crypto this summer, if the dollar's rallying, you're going to have a hard time. You're going to have a very hard time. So look for that dollar weakness if you think that the stock market is going higher, and that's the bet that you're making. By the way, if you're interested in these slides, email info@allstarcharts.com and make sure to use the password key support. Key support. If you don't use the password, they're not going to know which deck to send you, because I give a lot of different presentations, different audiences. You could get a presentation about Malaysian palm oil futures if you use the wrong password. I don't know. So make sure you use the right password. Key support. info@allstarcharts.com. Key support. And I'll go ahead and send you all of the slides. What are the stats? Hold on, let me get you the stats. I'll get you. You want stats? I'll get you some fun facts, right? I always got some fun facts. Let's see. The S&P 500 had its worst first half in more than 50 years. Based on CPI, if you're in cash, you're losing 8.5% a year. Based on this morning's number, I think it's over 9% a year you're losing if you're in cash. Great. Worst start to the bond market since 1842. What's gold doing? It's not an inflation hedge. It's not a safe haven. It's just a rock. It's a rock. It's a rock. And there's nothing wrong with rocks. If I can sell a rock at a higher price than where I buy that rock, I'm interested. I'll listen. I'll tell you this, though. When you price gold in other currencies that are not the United States dollar, gold looks a lot better, don't it? Doesn't it look a lot better? So the strong dollar has really put a lot of pressure on gold, because if gold is priced in dollars and the denominator in a fraction is increasing, fourth grade math graders out there, right? Fourth graders in your math class, the denominator is getting stronger. What does that do to the fraction? And that's why gold in US dollars looks like this. Looks terrible. But price in other currencies, look at Japanese yen. I mean, listen, to be fair, anything priced in Japanese yen looks good, right? Euro, I mean, it's going from the lower left to the upper right across the board. And then notice how much higher we are compared to their prior cycle highs, 2011, 2012 highs, right? These are 2011 highs in gold price in Canadian dollars. Look at where we're at now. Gold price in yen really ripped. Yen's been a disaster. So is euro for that matter. Look at the prior cycle highs way above it. Look at Aussie, gold price in Aussie, way above it. And then price in US dollars, we're below those former highs, right? So by the way, if you're interested in these slides, again, info@allstarcharts.com, password key support, and I'll go ahead and send that out to you because the bottom line is in America, we own gold. I mean, I don't own any gold. I might be buying some if the dollar starts rolling over, which it is today. So it's on my radar for sure because listen, I'll tell you this right now. For me, stocks and gold are both at the mercy of the US dollar. Stocks and gold have been under pressure with a rising dollar. It's been a major headwind. So I think if you finally get that weaker dollar, you're getting a weak dollar today. Let's see how long that lasts. But we're getting a weaker dollar today as I'm recording this on July the 13th of 2022. If you get the weaker dollar, I think that's good for gold, gold miners, that whole space that's gotten destroyed. And I think stocks do well too, right? Base metals probably do well. Base metal stocks, emerging market stocks, Latin America, international stocks in general. I think there's a bid across the board. So stock market bulls and gold bugs, I think, should be friends right now, right? Like your enemy's enemy is, right? What is that, right? Gold bugs and stock market bulls should all be friends right now. So that's how I see it. And the enemy is really the US dollar. And, you talk about the dollar because look at dollar versus yen, dollar versus euro, dollar versus British pounds, just ripping. And these three alone represent 83% of the entire dollar index. It's these three. I mean, euro alone is almost 60, right? So when you broaden it out and you look at the other G10 currencies equally weighted, Aussie dollar, Canadian dollar, yen, Kiwi, Norwegian krone, British pound, Swedish krona, and Swissy, when you equally weight those, you're still seeing strength, right? So it's not, you can't be like, oh, it's because the euro sucks. It's like, well, yeah, the euro sucks, but so do all the others, right? So it's not just that. And if you really want to get wild and crazy, which I like to, we'll take a look at all the biggest 30 currencies in the world, and we'll equally weight them. So the other 29 outside the US dollar equally weighted. So it's not just the dollar index, it's not just the G10 currencies, it's 30 of 29 of them equally weighted, and the dollar continues to make new highs against that. By the way, as we speak today, the dollar made new the emerging market. I didn't bring the chart, did I? Oh, I didn't bring the chart. The emerging market, actually, you know what? I will bring the chart. I have the ability to do this live. Here's what we're going to do. Here it is. Boom. Look at that. See the power of live streaming. So what do we have here? This is the emerging market currencies ETF, CEW, making new all-time lows as we speak, new all-time lows. We're looking at about 38% Latin America, 45% Asia, 26% Europe, new all-time lows. I think if that's the case, I think emerging markets are having a hard time because emerging market currencies and their stock markets are much highly, have much higher correlations than developed markets. So if emerging market currencies are making new lows, we're talking about a stronger dollar here. Don't expect emerging market stocks to do very well. I would argue don't expect stocks at all to do very well. It's going to be very difficult making money in the stock market if the dollar continues to make new highs. This is happening. And if you can get the dollar back under, the dollar index back under 1, I think stocks are flying. I think gold is flying. I think crypto's flying. Look at that negative correlation. We talked about how in May, the New York Stock Exchange Composite, the new highs list peaked. The New York Stock Exchange advanced decline line also peaked right here when the dollar bottomed, folks. When the dollar bottomed. We've seen dollar strength ever since and just deterioration underneath the surface. And sure, S&P's continued to make new highs into the end of the year, but most stocks had already been falling. So I think we're realistically 15, 14, 17 months into this bear market. And I really think what it's going to take is a weaker dollar. I think it's going to take a weaker dollar. And then if you're looking for evidence that, things are looking on the up and up, I think you need to see the new highs list doing anything on the new highs list. 33 straight weeks of more new lows than new highs. It's not going to cut it. I want to leave you guys with one stock. Take a look at Cigna. Healthcare has shown a ton of relative strength as of late. Ton of relative strength compared to all the other sectors. If we're above 273, I like this one long, 273. If we're below 273, leave it alone. Above 273, I like it long. Target up near 322. That's Cigna. Those are based on some Fibonacci extension levels. You're looking at about an $85 billion healthcare plan company. We're above 273. I like it long. Target of 322. And of course, if you want the slides, make sure to email info@allstarcharts.com. Make sure to use the password key support. I am your host, JC Parets. I hope that was informative. I tried my best to show you the charts and, what's got my attention. And that has my attention. If you want the charts, info@allstarcharts.com. Use the password key support. I'm JC Parets. Thank you for being here. Adios.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.